break the economy in order to achieve what they're trying to achieve.
We're just used to things, right? Our Gen Y is used to things happening super fast.
Mm-hmm.
But economic cycles have been happening for the last 300 years, and economic cycles take time. So what the Fed is doing by raising rates, they're making investors invest less because they can get 4.5% on bonds now suddenly, right? So they're investing less. Companies are hiring less. So eventually salaries get a bit deflated or stop rising. So people have less money to buy stuff, and again, I don't think it's a good policy, but poor get poorer in the process, where eventually it's supposed to lead to lowering inflation. But those cycles just take 4 to 6 quarters. Historically, it's taking 4 to 6 quarters for that to actually reach the economy. So everybody's asking, why hasn't it happened yet? Because it just takes time.
Okay, so question. The Fed has increased rates at 75 basis points. And as I showed you guys the chart a few seconds ago, very, very, very aggressively. If I look at the data for the next, or the probabilities for the next FOMC meeting, which happens on the 2nd of November, there's a 97.4% chance that we're going with a 75 basis point rate hike. Wouldn't it be more prudent for the Fed, given what you just said, Yoni, wouldn't it be more prudent for the Fed to chill and see what the effects are of what they have done before they carry on doing what they're doing? And I'm saying this because if you look at it on a US only basis, okay, maybe. But if you look at what's happening as a result of these interest rate hikes and the strong dollar, what's happening to all the emerging markets, and not even emerging markets, the euro, the Japanese yen, the pound, wouldn't it be a more prudent approach to say it takes 4 to 6 months, as you say, for the cycle to feed itself in?
Quarters.
4 to 6 quarters. Why shouldn't we just wait and see what happens with what we've done?
So everybody, again, economists usually look at history at sort of, decades. And what scares people is potentially hyperinflation. And the thing with hyperinflation, that it's a loop that sort of feeds itself. And that's the scariest thing for any economy, getting into inflation. Once you get into plus 10% inflation, that feeds itself, and then it's very hard to get out of that loop, right? So last time that happened in the US was late 70s, early 80s, and people are just afraid of doing that, and that's why they're sort of using all of the ammo that they have to try and stop inflation while it's under 10%. Again, from a hopium point of view, I'd love the Fed to stop doing what they're doing. It's bad for my crypto portfolio, it's bad for my stock portfolio, it's bad for business. But if you look at why they're doing it because economists are and people are scared from hyperinflation. Hyperinflation in the US is chaos.
Okay, so I guess then you condone what the Fed's doing. You think that another 75 basis point rate hike is pretty okay, given what you've just said.
I guess the question is, where's the terminal rate? I mean, at what point do they indicate that they're going to stop? Because another 75 basis points already anticipated in the 2-year. You're 4.5% on 24-month money. The stock market is fibrillating. It's having a lot of volatility. The VIX is trying to figure out the moment the Fed pauses. And so this is the interesting challenge. I don't care if you're in crypto, your equities, or bonds. What happens in these cycles, and this is always a challenge, and we have a good example in recent times, 2020, in the middle of pandemic, total chaos around the world and the markets. The stock market actually did quite well because there was all this QE coming into it, this quantitative support and the Fed printing money. But all of the returns, 95% of the returns came in basically 18 trading sessions, 18 8-hour periods, where you had that volatility, 2,000 points up, 2,000 points down. You just didn't know which day those up days occurred. And so if you were trying to time the market, you missed the entire returns of the year. The same thing is going to happen here. As soon as people figure out or feel or just get the tone from the Fed that they're going to take that pause, you're going to have a violent swing up in the market. And if you're not in the market that day, that's half your returns you'll miss. It'll happen in a few days. And so, everybody tries to time the market. It's impossible. Everybody learns the hard way. I did years ago. So I stay the course. I try and add a little bit on down days into just an index. I use a broad index of both mid cap and large cap stocks that Alps put out, and shameless in telling it's OUSA and OUSM. But those indexes are 300 really high quality stocks in the US that pay dividends. And they're violently volatile, except yesterday was crazy up. So I'm glad I was in the market yesterday. Same thing could happen today. You just don't know. Timing is impossible, and this volatility makes everybody squeamish.
So I agree with you.
Just to answer your question, I think the issue, you're right. A point, you said this, I said this on Twitter as well. 50 basis point hike is what the market probably needs. Here's fundamentally the issue, okay? And this was, I tweeted this out before, obviously, the inflation numbers. The issue is that the Fed they lost their credibility a while ago. And they actually messed up last year. When inflation started going up, they went, oh, it's transitory, and everyone believed them, or some people did, and they didn't move the rate hiking cycle up earlier. So they've been the reason you had those charts with the steep the steep climb in interest rates versus all previous years and decades was because they were behind. They had to play catch up because they messed up. And so here's the point. Like, they messed up last year. Do we trust them to do the right thing right now? They have a credibility problem. They don't have a choice. They've got to raise 75 basis because they said they're going to effectively keep rising to the point that real rates are positive. So literally, like, the Fed's, their brittle ego is going to determine which way the market goes.
I mean, funny that you mentioned that. Someone sent me this video. I'm sure you've seen it, but I'll play it again just for the viewers around the narrative.
I really doubt that we're going to see an inflationary cycle.
Most economic analysts believe that it will have a temporary or transitory impact.
The faster than expected increase in some of those prices is actually a good sign.
The overwhelming consensus is going to pop up a little bit and then go back down. No one's talking about this great,
This is something that will settle down.
Transitory.
And the data shows that most of the price increases we've seen were expected and are expected to be temporary. There's nobody suggesting there's unchecked inflation on the way. It's highly unlikely that's going to be long-term inflation that's going to get out of hand. I don't know anybody who's worried about inflation.
Over the last couple of months, we actually saw it trended downward.
President Biden's chief of staff, Ron Klain, enthusiastically retweeted an economist who had said, in part, most of the economic problems we're facing, inflation, supply chains, et cetera, are high-class problems.
What is the Granholm plan to increase oil production in America?
Oh my God, that is hilarious. Well, the number one thing that the president can do is help get COVID under control. That we know is the root cause of inflation.
President Biden this afternoon saying he thinks we're at the peak of the crisis right now and that lower prices are on the way.
The inflation has everything to do with the supply chain. Make no mistake, inflation is largely the fault of Putin. I'm going to do everything I can to minimize Putin's price hike here at home.
If you want to get rid of inflation, the only way to do it is to undo a lot of the Trump tax cuts.
Ever since you've come into office, things are really looking up. Gas is up, rent.
I mean, this was clearly an anti-Biden thing, but I mean, that is the narrative that the Fed and the administration has fed us for the last year, right? So I guess that's why nobody does it. Vinny, can I be presumptuous and say that you're now calling for 75 basis point rate hike?
No, I don't think. I mean, now they don't have a choice. If there was any opportunity for them to not look. I would say there's a 10% chance that something happens between now and in the next meeting. Maybe 10-15% chance. They need something to break. Treasury, bonds, some part of the market to dislocate to actually stop the 75 basis point hike. But what is interesting is the rebound yesterday, which we should talk about, and how because the market dumped. Okay, so I was up at like 5:30, and we watched like a pretty red day starting off, and everything dumped, And then we saw this turnaround. And I don't think it's because I think like once people had a chance to digest the numbers, it looked a lot better than what it was. But what was interesting is a lot of people were betting to the downside, and a lot of the shorts got squeezed big time. So if you look at this chart here, this was a classic like short squeeze in this situation where the moment people bought this dip up, people thought it was going to go lower. And Bitcoin, is this the Bitcoin chart? This is USAC, but
That's
Bitcoin chart.
It's the same chart. So here's the Bitcoin chart on the 1 hour. Let me just get it for us on the 1 hour. It's exactly the same chart. Specifically on Bitcoin, what we know is that there was a massive short squeeze because we were watching the long-short ratios, and we could see that there was a 3-to-1 short to long leverage ratio before yesterday. Actually, when I looked at it today, by the way, I've got the leverage here. There's still a 2.5-to-1 short-long ratio on GMX. Now, GMX is just an indicator. It's not all the leverage in the market, but it is quite a reliable indicator. And we've been tracking this and using this as an indicator. And every single time that the shorts outnumber the longs by more than 2-to-1, you get a short squeeze. And the other way around on the longs. When the longs outnumber the shorts by 2-to-1, then you get the longs getting wrecked. And it's been we've back tested it on about 10 big moves. And what it's showing you now is that the next move is up. So let's see if this indicator is actually right.
I think like fundamentally there's a breakdown in trust globally. And so if you look at what's happening in the gilts market and around the world, I mean, we have a looming energy crisis in Europe. I mean, people don't appreciate how bad this could get, depending on how cold the winter gets. And so what I try to explain to people with Bitcoin in particular is the Bitcoin being stable is only stable in dollars. Okay, it's been around 19K for a while. In other currencies, it's rising. So if you're in rands, if you're in whatever other currency in the world that you're in, you're seeing the price of Bitcoin going up. And now if you see inflation numbers are high, every time the Fed hikes rates, it effectively draws liquidity out of whatever local currency you have, which weakens the currency. So they have to respond by raising rates as well, or their currency gets weakened. But the impact is felt on the one global asset, Bitcoin, which is traded everywhere in the world. If you live in South Africa, you don't really care about the dollar exchange rate. You do care more about the price of Bitcoin in rands. And this is something which is really, really interesting, because I think this is going to basically be the catalyst for the next Bitcoin run. Is higher Fed rates basically weakens foreign currencies and people flee those currencies. It's kind of Gresham's law sort of,
So it's so interesting that you said that, because that's the narrative we've been talking about on the show for the last couple of weeks. We've been saying, look, the reason why we think that this is going to be a Bitcoin cycle and why Bitcoin dominance is actually probably going to go up towards 50% in this is because people.
I said that first one last year. Do you remember that conversation?
I'm not sure if you did, but I think it is. I think it's because we've both lived in South Africa, and having lived in South Africa, we appreciate what happens when a currency collapses. Now, for people living in the United States, it's very difficult to comprehend what happens when your currency devalues 20% overnight. For people living in South Africa, Argentina, and I mean, even places like Europe now, where you look at what's happened to the European currency, it's obviously not as aggressive. We understand that you need something that's transportable, and somewhere that you can get your money out in and out of very, very quickly. Specifically, if you have to leave where you're at. So, I mean, one thing we've seen with Russia, Ukraine is that a lot of the Ukrainians had to leave. So if you own property, if you own gold, if you own silver, you can't leave. You can't take that with you. And I think that's a big thing. Yoni, and Kev, do you guys agree that this is potentially a new cycle for Bitcoin, where as emerging market currencies start to collapse, not only emerging market currencies, but even other big currencies, as they start to collapse relative to the dollar, people may flee into Bitcoin because that's a safe place to be?
It might happen it might happen that way, but let me suggest a different reason to start going long Bitcoin, which has nothing to do with foreign currencies, but a lot to do with policy in the United States. There's two bills floating around, but let's talk about the one that has the chance of actually getting passed in the US after November 8th, which is the midterm elections. It almost went to markup last week. It's called the Stablecoin Transparency Act. Now, this has nothing to do with Bitcoin, but it has a lot to do with the tone of regulation. And the reason I think it's interesting is they're trying to solve for the challenges that occurred in these collapses of stablecoins that were built around algorithms. 62 billion got erased. The regulators got upset about that, although the majority of that capital, because it was decentralized, was in other countries. But This act is very simple in nature, which is why it may pass. It's being supported by both parties, and the reason that's the case is that it makes effectively the US dollar the default payment system worldwide, which everybody can get behind. So if you have USDC or any other stablecoin that's backed by the dollar, and the test to get it regulated is very simple. You're going to get audited every 30 days. It has to be backed up 1-to-1 with a dollar or a treasury bill. All the treasury bills backing the coin or the token have to have a duration of less than 12 months. And if you're willing to go through that scrutiny, they'll issue you a license. Now, if that were to happen, and it may happen very quickly after November 8th if the House flips, and that's the anticipation is House flips, nobody knows what's going to happen in the Senate. That's a coin toss. But even though it has nothing to do with Bitcoin, that'll be the first regulation passed by US regulators. And I would argue you want to be long Bitcoin going into that outcome. So if you own stable coins, you're going to see a lot of interest in institutional capital coming into, let's say, USDC and Circle. Circle, by the way, took in $200 million from Fidelity and $200 million from BlackRock a few weeks ago in a Series F at a $9 billion valuation. They got $54 billion of coin. So end of the day, regulation comes, Bitcoin goes up. And I agree with your thesis that it's a good asset to have if you're in a country where your currency is collapsing. But if institutions smell policy, then you've got a real move up. And that's when you break out of this $19,000 to $22,000 trading range against the US dollar. I think it goes right through that very quickly.
Yeah, I mean, you mentioned that. I think that's a point that a lot of people are missing. How important it is to regulate stables, because stables are the on-ramp for people to come and play with us on the ecosystem. On that note, though, what I did notice around USDC specifically is that they're facing a very large decline in the number of USDC in circulation. So they were on about 56 billion. They were catching up. They were catching up on USDT, which is Tether, and today they're looking at 45 billion. So they've lost about 20% of their coins in circulation. Now, initially, what I thought was that they lost the coins in circulation because people have lost interest and have withdrawn their money, and we don't need as many USDC. But then I looked at USDT, and if I look at USDT hasn't, if I remember correctly, well, let me just very quickly just check this. Here we go. So, okay, so they're down. Okay, they're also down, but they were down from the same time from 72 million to about 67 billion. Just to give you an idea, there has been a sharp drop in the use of stablecoins, and I think USDC suffered a lot more than USDT. Any idea why that would have happened? Is that just people losing interest in crypto?
It's no, it's the other side of exactly what Kevin said. It is quite clear that USDC is the more regulated stablecoin out there. But with what happened with Tornado Cash, with what's happening around sanctions, travel rule, FATF, sorry for using acronyms, but what's going on is people outside now the US, people in Asia, people in countries that are concerned more about, by the way, what Vinny talked about, right? So a lot of people around the world who have wealth are concerned about their money getting frozen, their money getting confiscated by governments. Again, most of the people around the world are not in Western countries. Their fiat money is going eventually to zero in the next 30 years, most of them. And they don't necessarily trust the local banking system. So for them, it actually scares them when they think about the fact that in theory, US regulators could have control over USDC. So I think, by the way, it's very important to have this dynamic of something that's more regulated and less regulated, especially when we think about global citizens around the world. But it does seem like when we operate in Asia, we see a lot of people who actually transition from banking to operating 100% in crypto and stable coins.
There's another reason as well. 45 days ago, you could take and you could lend or stake your USDC within your wallet. Let's say you had a wallet at Circle. You were making 3.8 to 5.2% for 30-day or 6-month or 1-year contracts. That was the spread. And you were putting that out very easily on their platform. Today, the only interest you can make is 50 basis points. When and you're looking at 2-year treasuries at 4.5%, there's no competition. Part of the challenge USDC has is it wants to get regulated so it can act as a sweep account and start to be competitive against bank accounts that are offering 1.5, 2% interest rates. So you have no incentive to keep your stable coin in your wallet. You're transferring back to US dollar and parking it back in a fiat currency where you can get risk-free, basically a treasury bill for 24 months, 4.5%. Now, the company's not allowed yet by regulators to do that. That's the circle for USDC. So they're in an uncompetitive situation, and it's a disadvantage. That's why they want this regulation. They can start, even if they act as a bank, they can compete with bank interest rates. But you have your money sitting in USDC, you're basically making nothing in interest. That's the real challenge.
Unless you want to invest it in DeFi, and I think everybody's very, very, very scared of DeFi at the moment, especially given what happened over the last couple of months. But I guess it is a very interesting environment to be in, where the interest rates in DeFi aren't as competitive anymore. And interest rates on 2-year treasury yields, as you say, are 4.5% or whatever else. I saw this tweet, and I want to just talk about this tweet for a second. So JP Morgan reported its highest quarterly net interest income ever, and actually raised its guidance for the year. This is the money that banks earn on loans minus what it pays out for deposits. So now cue the discussion around why banks aren't paying more on their customer deposits. That's one thing I want to talk about. But more importantly is Jamie Dimon has been anti-Bitcoin for a long time. He was anti-Bitcoin in 2017. He is still as much anti-Bitcoin today, 5 years later. At the same time, his bank is recommending Bitcoin, making it available, having custody for their clients in Bitcoin. Why do you think Jamie Dimon has such a negative stance on crypto?
I think it's just bad for his business. His business is generating on the $1.2 trillion of cash money, generating revenues on stock trading, on capital markets, on bonds. His business isn't crypto trading, and it's just bad for Bitcoin is bad for the banking business in general. It creates disintermediation. It creates significantly more competition in the space with innovation that's faster, that can be implemented in traditional and regulated banking service. So I think he's just, and potentially rightfully so, talking his book. It's just bad for Bitcoin becoming digital gold and going to $100,000, $200,000 is bad to JP Morgan's business.
His stock, along with other bank stocks last week, hit new 52-week lows. Part of that challenge is this concept of the Stablecoin Act being passed, and that specifically hurts him on ACH transfers and wire transfer fees, which are very high between banks, particularly across economic geographies. So if you're transferring from US dollar to Swiss franc through an ACH, you're going to pay a lot of fees, and you pay a lot on the SWIFT transfer as well. And those banks make millions of dollars each quarter off those fees. If all of a sudden you were allowed to use a stable coin at a fraction of that cost, and both regulators allowed for that transfer, that would really hurt profits in banks, not just JP Morgan. And so you're seeing a lot of that issue right now in the equity values. You would think as rates go up, these bank stocks would be moving north. No, they're hitting new 52-week lows. And part of this is the market trying to anticipate the disruption when it's going to happen. Here's a question for every investor to think about. There's a risk in investing in Bitcoin and all crypto. There's also a risk of not investing in it, because if it's true that it becomes the 12th sector of the S&P in the next decade, some of the value in financial services stocks like banks, like money center banks, are going to transfer to these new technologies, and you simply don't know when that's going to happen. So my thesis is you should have some crypto in your portfolio, because you don't know when that's going to occur. And if you completely don't have exposure to it, you may miss participating in the growth of this 12th sector of the S&P, which would be a bad outcome for performance.
How much of your portfolio is currently in crypto?
It was 20% before the correction. It's now 16.2. We monitor it every day, just like we do stocks. We're having a very hard time with our auditors and internal compliance people because it doesn't act like an equity. It doesn't act like a bond. It trades liquid 24 hours a day. So mark to market means nothing at 4:01 in the afternoon. So we're constantly monitoring that. But I'm not the only person that has this view. We are adding to that position because in the way we manage our operating company's portfolio, we can have any sector up to 20%, but no more than 5% in any one position. So given that, we have a lot of different positions, and we just put capital to work in Miston last week, that project that came out of Facebook. We're always looking for new projects because we simply don't know which ones are going to survive. But we don't need them all to survive. We just need a portion, just like venture investing. But crypto is going to cause a lot of disruption, in my view, in financial services, which is a large sector of the S&P. So if you don't invest in it, you also have the risk of missing that transition.
Okay, I think that's a fair point. I think I buy the fact that it's probably as risky, or probably even more risky, not to be in crypto than it is to be in crypto at the moment, right?
I agree.
Kev, Yoni, what are your thoughts?
Well, first, I agree 100% that blockchain technology and crypto are going to significantly disrupt everything in financial services. Now, as a fintech entrepreneur, founded eToro 15 years ago, and have seen sort of how much financial technology progress, you can't compare that into what we're seeing in DeFi. It's like comparing something from 25 years into the future to the present. So innovation is significantly faster, and there's no doubt that most assets in the world are going to transform and become digital, and therefore exchanges, central bank digital currencies, we're going to see that, which means the technology of crypto and blockchain is basically going to eat financial services eventually. Now, that doesn't mean some banks can't leap into that transition, but it's going to be very hard for non-tech driven companies to basically become not only tech companies, but sort of digitally native blockchain companies. The second part, which I think is sort of more macro, maybe sort of longer horizon, is the success of crypto eventually, and I think that's what's scaring regulators and governments around the world, is a potential lead to the largest bank run in human history, right? That's also the challenge in central bank digital currencies. If retail investors could invest in the dollar directly into the Fed, why would they have dollars in banks? Because it's safer to have your money directly in the Fed if the Fed's giving you Fed interest rates. That's mean no intermediary. You're getting the 3.25 or whatever Fed rates are, or Israel shekel rates are, or pound. In the UK, you'd be investing directly into the Queen's Bank. So if that happens, that creates a huge financial instability to the current fractional reserve system, because if retail investors can invest in central bank digital currency directly into the dollar and the pound, which pays them the actual interest rate of the bank, then they'll pull all of their money out of the banking system into those CBDCs. And if that doesn't happen, potentially they pull all of their money into something like Bitcoin or Ethereum or other cryptocurrencies. So as this process happens that Vinny talked about before, right? And these are long-term processes, right? We've been 10 years into this. In the next 10 years, people are going to see a 20-year chart of Bitcoin versus the local currency, and they're going to say, okay, it doesn't make sense not to own Bitcoin if I live in any place that the value of my local currency significantly devalued against Bitcoin. And as that happens, that creates a significant risk of a bank run, which again is very bad for the banking industry and the financial services sort of index as publicly traded companies.
Cool. Vinny, any thoughts there? I think you're muted. Is Vinny muted?
Muted. Sorry, I agree wholeheartedly with both Kevin and Yoni. I think that there's another thing I'd add. Like this bear market, there's been a year when no one's really paying attention to what's happening in crypto. Everyone's the focus has been on the price, not the underlying technology and what's actually been happening. Everyone's been going, oh, the price is going down. And I've been in crypto Bitcoin since 2013, so it's been 9 years now. I've seen this happen, this cycle play out multiple times. And whenever we're in the bear market, everyone forgets about the technology, what's being developed, and the progress we're making, and everyone focuses just on the price. And then suddenly someone wakes up and goes, oh, we're in a bull market run. Everything goes to the roof because they look back and go, oh, this is so much tech was built in the past 2 years. DeFi's come out, this has come out, whatever. And then you have a bull run, right? So the same cycle is repeating itself. The market's basically very blind to what's going on. And I put a tweet out a couple of days ago where I showed, for example, on Filecoin. And Filecoin is doing over 2 petabytes a day worth of storage across 100,000 transactions. I mean, that's real utility and that's real use for a blockchain, right?
I think there is a lot of building and a lot of adoption happening behind